Hey everyone, thank you for joining me. In this video, I'm going to highlight one growth stock that's down 71% off its high that you might regret not buying on this dip. But before I reveal what that growth stock is, I'm going to discuss some of its financial metrics to show you why I like this growth stock and why I think it's a buy on the dip here. So let's get right into it. Starting with this company's revenue growth, and you can see a very nice upward trend here, and notably a big boost in 2020. And yes, this company was a prime beneficiary of the pandemic when people were staying at home and spending money online. This company benefited from that trend. And now, as economies reopened and people are spending more money on services, growth has slowed down temporarily, I will say, temporarily for this company as consumer behavior has shifted. But in the long run, the company will return to growth. The company should return to growth, I should say, when consumer behavior normalizes again. Another reason why I like this growth stock is because it's very strongly positive in terms of cash flow from operations. There's a lot of growth stocks in the market today that are growing revenue rapidly, but they're losing a lot of cash. And to me, that's a bit risky because that business is not self-sustaining. They're going to need to go to the markets and raise more capital. They're going to need to borrow money. They're going to need to do major changes in order to fund themselves because their business itself is not generating cash flow. That's not the case for this business. Very strongly positive in terms of cash flow from operations. Again, the trend is a little bit downward for the same reason I mentioned earlier, in that it was a very strong beneficiary of the pandemic. So it's understandable that the cash flow from operations right now is less than it was in 2020 and 2021 and 2022, when people were spending more time at home, people were spending more time on physical, tangible goods instead of services. Right now, people are spending a lot more money on services, things like travel, concerts, restaurants, things like that. And that's been harmful for this company, but this is temporary. This is a temporary shift in consumer behavior. In the longer term, in the longer term, as a percentage, people are going to shop more online, and that's going to be a benefit for this company. And so, for that reason, this temporary dip is a buying opportunity, in my opinion. So, let's keep going. Another thing I really like about this company is its operating profit margin, which I have pulled up here. Looking out over the last 10 years, you can see the upward trend in terms of its operating profit margin. Again, a big boost in 2020 that's come back down as consumer behavior has moderated. But if you look back over the longer term, back to 2015, you can see an upward trend in the profitability of this company, and ending at a very respectable 14.47% operating profit margin. If the company returns to growth, which I expect it will, this operating profit margin should continue rising higher because the business model itself is a lucrative business model. The company runs an asset light business model. It has a platform that brings together individuals, and the company takes a percentage of the revenue that's generated on the platform. And so it doesn't need to invest large sums of capital to sustain the business, to grow the business. And so that's good news if you're an investor that likes companies with strong profit margins like I do. I'm attracted to companies with strong profit margins. And finally, one of my favorite reasons to buy this stock on the dip here is because of the valuation. What I have here is the forward price to earnings ratio, and this growth stock is trading at a forward PE of 17.74, which is the average growth, which is the average valuation of the stocks in the S&P 500. So it's got an average valuation compared to all of the stocks in the S&P 500, but compared to itself, you've hardly ever had an opportunity to buy this stock this cheaply. Look back here. You've hardly ever had an opportunity briefly around May of 2022, June of 2022, you had an opportunity, but that's about it. You haven't had many opportunities to buy this stock this cheaply. So, for all of those reasons that I highlighted, a good profit margin, excellent growth, good prospects for the long term, an asset light business model, that's why I think this growth stock is a buy on this dip. So, what is this growth stock? It is Etsy, the platform that brings together buyers and sellers to buy and sell custom made goods. All right, so that's all I've got for this video. Thank you so much for watching.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.